Thank you. Well, good evening, and congrats on your engineering career at Michigan State. I'm a proud alum. Knew Garth back when we were crazy freshmen in Acres Hall, and I'm very, very proud to be a Michigan State grad. So I was a teacher for about 26 years, and then I left education and got into finance and banking, and came across a role that involved teaching finances and education. And as I started to work with people in all varying degrees, I work with several different engineering firms down here in Indianapolis, along with manufacturing, fast food, colleges, Butler University, the city of Indianapolis. I have like just a wide range of customers. I found that we do a really poor job of preparing the average person for a good financial life. So what I'm going to try to do today is give you some real basic, what I like to call rules of the game. So if you can imagine playing Monopoly and everyone knows the rules but you're going to lose the game. It's not fun to play when you don't know the rules. You're always behind, you're trying to figure it out. Well, think of finances as a game. You can't win the game of finance. You can't build wealth if you don't know the rules and those kinds of things. So people who get wealthier, and most of the wealthiest people in our country actually didn't start wealthy. A lot of them started with absolutely nothing, but they were curious and they asked a lot of questions and they educated themselves. So I'm going to give you enough information that when you get your first job, you're going to have enough information to like get you started, but you need to keep learning and you need to keep asking questions. Ask professionals that are in that industry and in that field. Make sure you have the rules or you'll never get out of paycheck to paycheck and into a quality life of some wealth. So we're going to start with the most important piece of education, and that's credit. And a lot of people don't understand how important that is to your life and how it builds wealth and some of the misnomers about credit. So a lot of people are real scared about credit, and really it only has a place in your life at certain times that it really, really matters and has a huge impact, and the rest of the time it really doesn't. So I want to give you the truth about credit, and then we're going to talk a little bit about when you get your first job. What do you do with budgeting? What does that look like? And what's the difference between maybe a Roth 401k and a traditional 401k? And what's the difference between a 401k and an IRA? And when you look at healthcare with your benefit package, what's the difference between a PPO plan and a high deductible plan? And how do you make all those important decisions the first day of work when HR says, here, we're onboarding you, elect what you want? And they throw a big package at you and you have to start checking what you want and you don't even understand it to check it. So what do? Call mom and dad and say, what do I do here? And sometimes mom and dad know what they're doing and sometimes they don't. So I want to give you just enough information that when you go to that HR and they throw a packet at you, you have a little bit of firepower behind you. So we're going to talk with exploring the importance of credit scores. We're going to learn how to access your credit report and why you should pull it annually every single year from one particular place. And it's not Credit Karma. We're going to talk about how to build and improve your credit so you can build wealth, and then how to protect yourself from fraud. And then lastly, I added some slides to this on what to do when you first start a job and making those very important decisions.
We're going to let you go through this, Nancy, and just as a point of interest to the students, as she's going through this, if you have a question, just throw it in the Q&A. If I think it's a timely question, I'll interrupt Nancy like I just did. Throw the question out. Otherwise, we'll hold it till the end.
Yep, please do if it's important. It's always better interactive, kind of thing. So let's talk about what a credit score is. So first of all, it's a 3-digit rating that tells a lender how likely you are to repay debt. That's basically what it is. So it is considered to have poor credit if you are under 580. So 479 and below is bad credit. Very difficult to get any kind of a loan, especially in the COVID world. Just so you know, Everyone's scores have gone up a little bit during COVID because people have been given all kinds of forgiveness and hardship. So along with that, scores for loans have gone way up. So I can tell you under 580, you're not going to get a mortgage for a home from anybody. Probably not a car loan either, from anyone. Even the lowest lenders are not going to lend under 580 in today's world. 580 to 669 is fair. It's okay. You can get some products, but when you get a product at that, you're going to pay a price for it. You're going to pay way more than someone else. 670 to 739, you have good credit. It's good. You can get some credit cards at 670, not all of the cards, but some cards. You can get a mortgage, you can get a car loan, you can get some of those, but you're still not going to get the best that's out there. At 740 to 799 is very good. You're going to get top end of most things. And we'll talk about what that means when I say top end in a few minutes. But when you get to that point, a lot more comes your way. And if you are at 800 to 850, you have exceptional credit. It's hard to get that. Even people who've had great credit their whole life, once you pay your mortgage off and you lose that, your credit actually dips a little bit. And I'll explain that in a few minutes too. So you really want to strive for that 740 and higher. I always say 780 and higher, you're pretty golden for anything you want to get at the best rate that you want to get it. So let's move on to the next slide. So what if you have no credit? Okay, so if you have no credit at all, it's almost worse than bad credit, because once you get to a certain age, it's hard to get somebody to give you a credit card or loan you money if you haven't established any credit. So if you don't have any credit, you need to open a line of credit in some way. So one of the ways you can almost always open a line of credit is to do something called a secured card. So the bank I work at is BMO Harris Bank. We don't do a secured card. So I always send people to Discover Secure It. There is a Discover Secure It card. You have to give them $200 and then they give you a card worth $200. That $200 is held as collateral for the card. And then you can use that card to start to build your credit. So how do you build your credit? Well, you build your credit by using that card once a month for a pack of gum, $2. Use that card, $2. A week later, when you see that that show up on your phone, you get on your phone and you pay that bill, and it will report to credit as a use and a paid on time, and you'll get a 1 on your credit report. You do that for 2 years straight, you get 24 ones. You don't owe anything on that card. It's at 0. You're going to build your credit quite high, quite quickly. And we'll talk about a little bit more about those different parts of credit, but you need to open some type of a credit. Next, request that your payment history be reported. So some secure cards don't report history, but most do. But make sure if you get a secured card, you ask for it to be reported. If you don't want to get a secure card, you can get a regular credit card or a store card like Target or Macy's or Lowe's or something like that. If you can get a parent, or maybe you're already going to get married and your spouse has great credit, and they'll open an account joint with you. Generally, most lenders will put you both on the account and it will report to both of you, and you can begin to build your credit by being joint on with someone else. Now, you can't be added as a user. So if your mom and dad have a credit card and they've given you one and they've added you as a user, you are not getting any credit for that to your credit report. So you have to actually be a joint owner for it to affect your credit report. And make sure that you pay all bills on time and in full and never miss a payment. And we'll talk a little bit about that some more as well as we move on. Okay, so I'm going to tell you the tale of two friends. So I've got Anna and Bella, and they've been friends since middle school. They both own cars and they have great incomes to pay their bills. But Anna has not done a very good job of being on time with things, and missed a few payments, done a few things. And she has a 530 credit score, which I told you was very poor. While Bella has just one credit card and her car, and she makes her payments on time every month. And she has a credit score of 700. So when these two go to buy a home, Bella's going to have no problem. She's going to have lots of lenders willing to lend her money. Her closing is going to go more smoothly. Anna, on the other hand, actually right now, she would not get a home loan. They would tell her no. If she was lucky enough to find somebody to actually loan to her and give her a loan, what she's going to find is her interest rate is going to be 2 to 3% higher than Bella. So what does that mean when I talk about building wealth? What that means is that Anna is going to pay for the same loan. So let's say both of these girls take $150,000 to buy a condo. Okay, same exact 150, and they're both going to do a fixed rate for 30 years. So we're going to compare an apple to an apple. So 150,000, 30 years, fixed rate. Anna's credit score is probably going to give her a rate of about 5%, and that's pretty high in this rate environment right now with COVID. Bella is going to get the rates that are going right now, little bit higher. You can get a rate for about 2.7 right now, so she's probably going to get about 3%, so about 2% less. What that equates to is almost $200, a little over $200 every single month for the next 30 years. Anna is going to pay for the same loan $200 more every single month for 30 years. That's a car payment. Okay, that's a lot of wealth. Bella's going to be able to save that $200 when she has an emergency. She's not going to have to use a high rate credit card. She's going to have a savings account because she has that extra $200. So when you have poor credit and lenders decide to lend to you, they up your percent significantly, a lot, because they really don't care if you get the loan or not. You're very risky to them. Whereas Bella poses very little risk. Bella is proven to us that she can pay her bills. So we'd like her as a customer. So we're going to give her a better rate so she chooses us and not another institution. So somebody that has 800 credit, I'm telling you, lenders are drooling. Like, they want them so badly because they are going to give them the best rate. They might give them some promotional money, all of these things. So a lot of times when I do this seminar, people look at me and they say, that seems so unfair. You know, poor people have low credits and rich people have high credit. And that is absolutely not true. Some of the poorest people I know have 800 credit because they pay their bills on time and they know what to do. And some of the wealthiest people I know have horrible credit. So you are rewarded for the behaviors that lead to a high credit with a lower score, so you can pocket more money every single month over those 30 years. So who comes up with these credit scores? How does this happen? Well, we have 3 credit bureaus in the United States currently, 3 main credit bureaus that almost every lender uses. And they base their information on some of your habits that I'll show you on the next slide. But the 3 lenders are Experian, Equifax, and TransUnion. When you use something like Credit Karma to see your score, you need to know that Credit Karma is only pulling one of these to look. So it's not giving you a full snapshot. So I've literally had people walk into my office and say, Nancy, I'm ready for that mortgage. My credit score is up to 680. And I say, okay, you know, let's get the ball rolling. And we do a credit pull and they're at 580. And I'm like, did you use Credit Karma? And they're like, yep. I'm like, not an accurate source. So the one accurate source is a place called www.annualcreditreport.com. And I'll put that up here in just a few minutes for you. And I think Garth is going to give you access to this at the end. He's going to email out a whole bunch of things. So let's talk about, before I give you that website, let's talk about how that 850 score gets derived. So the highest you can get is 850. So over here on accounts owed, the peachy colored part of the pie is slightly the largest part. 35% of your credit score is based on how much you owe and how much credit you have available. So if you have a credit card that has $1,000 limit and you owe the whole $1,000, you have maxed out that card, this 35% of your credit score is going to be very, very, very low. Okay. So if you take 35% of 850, that's going to be completely based on how much you owe. Now, let's say you have $1,000 card and you only owe $100. So you have 90% of your available credit. You are going to have a very high percentage of those points when you use less. So the general rule of thumb is stay under 30% for any cards that you have. So if you have a Kohl's card or a Lowe's card or Target or Macy's or American Eagle or whatever cards are in your wallet, Discover, Amex, whatever the limit is, keep the balance under 30% if you want to maximize this 35% of your credit score. The second largest factor of your credit score is 30%, and that is your payment history. So every month you need to be making a payment. And if that payment is not on time, before the due date or on the due date, then you are not going to get a 1. 2 years of payments show up on every single line of credit. So if you have 2 credit cards and a car loan, you're going to have 24 months of history on those 3 items. Those are called trade lines. So you're going to have 3 of those 24 months. And if they're all ones, then 30% of that 850 is going to be extremely high for you. If you have a few 2s in there, it's going to drop a bit. When you get 3s, 4s, and 5s, that means you've paid 2 months late, 3 months late, 6 months late. Your credit score is going to be well below 500. Paying your bills on time is a huge, huge, huge part of your credit score. And actually, how much you owe and your payment history together is 65% of your score. So those 2 things alone can raise or lower your credit score more than anything else. The next one is the light green one, the length of credit history. And the length of credit history is, I gotta get back to my notes, 15% of your credit score of that 850. And when we talk about length of credit, it doesn't necessarily mean that you've held on to a card for 20 years, okay? It means that you've established at least 24 months on that particular trade line to show that you've been able to handle that credit over 2 years. So I can have an 800 credit and get a mortgage for 200,000 and see my credit drop to 740 when I close on that mortgage. That is not uncommon because I just picked up $200,000 in debt and I have no length of credit history on that debt. I have not been able to prove that I can handle that payment yet. As soon as I start making those payments and I start making those payments on time, I'm going to increase my credit score back up to 800 because as that length of that credit line extends and I'm proving that I can handle that debt, my credit starts to recover. If I make a late payment in those first couple months or those first 6 months, it's going to take me longer to recover because now I'm showing that I bought a home outside of my limits and I can't afford to make my payment. So length of history is pretty much anything 2 years and longer. You need about 2 years to recover from a hit to your credit on that. New credit and types of credit are each 10% of your credit score. So new credit is called hits to your credit or soft or hard credit pulls. So every time you apply for a card at a store or at a credit card company or at a bank, or you get a car loan, or you get student loans, or you get a mortgage, you're going to have a soft or a hard pull to your credit. If you do a whole bunch of credit at one time, it lowers your score significantly. I've seen somebody lower their score over 100 points in one weekend going car shopping and allowing numerous dealers to pull their credit to to see what kind of a deal they can get for them. So I would say work your deal before you allow anyone to pull your credit, because if you do that, you're going to see a significant drop. Now that will fall off if no loan goes through within about 30 to 60 days. They should bounce right back from that 100, but for those 60 days, they're going to be a little bit lower. Types of credit, 10%. There are 3 types of credit. Number 1 is an installment loan. That's going to be your student loans, car loans, any loan that has the exact same payment every single month is an installment loan. Number 2 is revolving credit. Revolving credit is any type of credit card and like a home equity line of credit. So a home equity line of credit means you own a home and maybe it's worth 200,000 and you only owe 100,000. That means you have 100,000 in equity in that home that belongs to you. Because if you sold that house, you would walk away with $100,000. So an equity is how much money do you have in your pocket if you were to sell that house. Okay. So when you have a home equity line, you might have $100,000 to borrow from, and you might owe nothing on it. Okay. That's going to help your credit owed, make that a lot bigger because you have a credit line that you're not using. And it also gives you an installment loan. Now, let's say you use 10,000 of it. Now you're going to have a different payment today than you did yesterday. And then let's say you get $2,000 back from the government for your taxes and you pay $2,000 towards it. Now you owe $8,000. So now you're going to have you're going to owe less. You're going to have a different payment now because of that. So the payment's constantly changing. Same thing with your credit card. If you use $100, your payment's going to be different than if you use $1,000. If you use $500, if you pay it down and then use it again, your what you owe every month is going to change. So that's why it's called revolving. So you have revolving, installment, and then you have mortgage, first lien on your home or your condo. So if you buy something, the very first lien on that is called a mortgage. That is the 3rd type of credit. So a lot of people are like, man, I can't get past 790. I can't get to 850. I have great credit. I pay everything on time. And they're young. They're 26 and they want to have an 850 credit score. And I say, do you have a mortgage? And they're like, no. And I'm like, then you'll never have an 850 credit score. You don't have all 3 kinds of credit, but it's okay. 800, 810, 790 is fine. You don't need 850 credit. When you're in those high 700s, low 800s, you're going to get every benefit that you would even if you had 850. So don't go get a mortgage just to raise your score. It needs to make sense in your life. The same thing when you pay off your mortgage. So you pay your mortgage off and people think that's a good thing. It is, and it feels good. And they think their credit score is going to go up and their credit score drops. And they call me and say, how did my credit score drop? I paid my mortgage off. And I'm like, yeah, because you dropped a type of credit and you dropped something in your history. So those 2 things are going to pull you down. But you went from an 840 to an 820. So who cares? It's okay. Be proud that you paid off your mortgage. So there's times when your mortgage or your credit score is going to go up and down naturally, and you don't really need to worry about it.
Nancy, we got a couple questions coming in about credit.
Sure.
One is from Christian. He asked, how accurate is FICO? MSU FCU uses FICO. I just looked it up, score 2 based on Experian data.
So it's going to be 1/3 accurate. Because there is no Expedia and there's no TransUnion. And I can tell you TransUnion is the hardest one. So when you're getting a car or a mortgage or things like that, they look at all 3 bureaus and do a calculation between the 3 of them. So when you go to buy a large purchase, that's going to give you an idea of where you're at, but the 3 of them can be off by 50, 60 points. So most places will take all 3 and then take a median of the middle or take the middle score period. And so I would say it's giving you a nice picture, but it's not the 100%. Don't be surprised if you go in and they do a credit pull and your Experian is 750, but your total FICO score together with all 3 is only 720 because TransUnion's the hardest one. So,
So I looked and I just pulled credit scores for all three, and I'm seeing a 53-point spread between the three.
Exactly. Yeah. Yeah. Not uncommon at all. So that's why people think like, and Credit Karma only uses one of them. And there's another one out there. I can't think of the name of it right now. And it uses just TransUnion. So the only place where you can see all three is annualcreditreport.com. And but here's what I can tell you, and I tell everyone this: I could care less what your credit score is. I don't care. What I care about are your behaviors that drove your credit score. So if you have a 600 credit score, why? Which one of these things on the screen right now is causing you to be so low? Are you using all of your credit lines are you maxed out? Are you not paying things on time? Have you just started credit? You don't have any history? Do you pull a whole bunch of new credit? What behaviors are you doing, or are there collections on your credit report? You know, what's causing your score? If you have an 800, great. Do you know why you have an 800, and what can you continue to do to keep that 800? So when I look at credit, I tell people the score means nothing to me. I need to see the report so I can see your behaviors. And then we can either fix behaviors or continue to do the right things as you go forward. So when you do all the right things, you're going to have 800 credit. You don't have to worry about it. You don't have to look at it every day when you're doing the right behaviors. So let's move on and talk a little bit about one of the things that happens to a lot of young people when they first get out of college and they have all these friends. Somebody might ask somebody to co-sign for them. Okay. Not uncommon. I mean, you would think friends don't ask friends, but friends do, or sometimes siblings or cousins or somebody. So, you know, Anna was the one with the low credit score. So Anna's house is now in foreclosure. She's taken some steps to improve her credit, and she has become eligible for a loan to get herself out of foreclosure. She wants to use the loan to stop all this process, but she needs a co-signer. So she says to Anna, I know you've been saving all this money. You know, you've done such a good job. Can you co-sign for me and help me, please? I don't want to lose my house. You know, so what does Bella do? Does Bella help Anna, or does Bella not? So just so you know, if you co-sign on anything, on a credit card, so if two people go in jointly together, on a car loan, on a mortgage, on anything, it is on both of your credit scores. So if Bella decides to help her friend Anna and she co-signs, whatever Anna does with that loan is going to affect Bella. So if she pays it late, then Anna's paying it late. If she maxes something out, Anna's maxing it out. So when you co-sign, you are owning the behaviors of the person you're co-signing for. So I would very much tell Bella, as much as you love your friend, this is not a good idea. She hasn't proven enough times that it will be effective for you. But that is her choice. But just know that if you co-sign with anyone, so this happens a lot with people that I've worked with that have gotten married and then 5 years, 6, 10 years later divorced. And one will say, I don't know why my credit's ruined. It was my husband's cards that got maxed out. He's the one that didn't pay his bills. I paid mine on time, every one of them. You know, his car payment was never on time. My car payment was on time. But they took all of these loans and all of these cars out together. So both of their names were on everything. So it didn't matter who did it. When it's in both names, it's in both. So it's important when you get married or you have a significant other that it's fine to have some credit together, but it's extremely healthy to have your own credit. So for example, I have my own car and the credit is in my name only. My husband and I did not co-sign on that. His is in his. I have a credit card that's only mine. He has one that's only his. We have one together. Our mortgages together. You know, so I have built mine without him, and he has built his. We've been married well over 30 years and plan to be married well over 30 more, but still good to protect yourself and make sure that you have established your own credit. Okay, we already talked about that. So what's in a credit report and what does it look like? So a credit report is a snapshot of you. It's got several sections to it, and it tells a lender how worthy you are. Here is where you get that free credit report I was telling you about. Annualcreditreport.com. Here's the 800 number, the website. It is owned and operated by all 3 bureaus. You have a right to 1 free credit report a year from each one of them without any cost and without any kind of a hit to your credit. So you go in here, you do have to put your social in, that's how they find you. You pull up and then it'll say, do you want, you can pull all 3 of them if you want. Now I'm gonna pre-warn you, if you need your score, you do have to pay, I think it's $5 for the actual score if you want that. But again, when I pull my credit every year and I pull all 3 of them every single year, I don't care what the score is. I'm looking for fraud on my credit reports, and I've had fraud in the past. I'm looking to make sure reporting is accurate. So what you're looking for when you pull your credit to make sure that before you buy your house, before you buy your car, you have the best, cleanest credit possible. So everything goes smoothly and you get the best rate. You want to look at the top part, which has your name, your social security, your past names, your date of birth, where you've worked in the past, where you've lived in the past. It usually has 2 to 3 addresses. And you want to make sure that information is accurate. So I'm going to tell you my story. When I moved here to Indiana, went to do something with our credit, and I said, oh, we have great credit. And I didn't know this information. I didn't know how to play the game. And they pulled my credit and they said, oh, your credit's okay. It's 700, but it's not great. And I'm like, wow, that's surprising. And they're like, well, here, I have it right here. Let's look at it. So we started looking at it. The very first thing I saw was an address for Nancy Hepp in Wisconsin. I forget the city in Wisconsin, but the street was Larimar Street. And I lived on a Larimar Street here in Indianapolis when we were building this house. Same street name, but a different city. And I was like, I've never lived in Wisconsin. I barely ever even stepped foot in Wisconsin. That's not my address. And so we went further into the credit report, and there were 2 loans that I was like, that's not my loan. That's not, I've never had a loan with this person, and I've never had a loan with this person. So the banker was great. They were like, okay, we're going to do a dispute. You're going to do a dispute. You have to dispute it. Even though you didn't do this, it's not your fault. You have to take care of your own credit, even when somebody else is at fault. So the banker walked me through it. So on this website, annualcreditreport.com, there's a tab that says disputes. So I clicked on this disputes and I said, this is not my address. These 2 things are not my loans. You know, I'm concerned about fraud. Somebody has gotten in, da, 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 da. We sent it off. They have 30 days to get back to you. They got back to me. There is a Nancy Ann Hepp, same exact name as mine, that lives in Wisconsin on a street that I lived on here in Indiana. And that is how her information ended up on my credit report. The credit bureau acknowledged they weren't my loans because it wasn't my social security number. They removed those 2 loans from my report, and they removed the address, and my credit went up to 805 that day. Like, unbelievable. If I had not pulled my credit and looked at it, I would never have known that that address was on there and that somebody else's name can commingle with your name. So let me tell you, if you are a Smith or a Jones or a Rodriguez, a Thompson, I would be looking at my credit probably 3 times a year. I'd probably pull Experian in January, I'd pull Equifax in June, and I'd pull TransUnion in October. And I would be looking to make sure that that's on there. Not uncommon for a junior and senior for people to come in and say, oh my gosh, my dad's credit is always on my credit, and my credit's always on my dad's credit. Happens all the time. It is your responsibility, even when it's not your fault. It wasn't my fault that her loans got on my report and that she wasn't paying them, but I had to fix it. So know how to fix it, know what you're looking for. So let's see, let's come down here. So here are the 4 sections of your credit report. So your personal information over here, I just told you your name, your birth date, social security, address, previous addresses. If you've been married, like my maiden name is Kuhn, so Nancy Ann Kuhn is on mine, and Nancy Ann Hepp. So if Nancy Ann Smith is on my report, I'm going to dispute that. I've never been Nancy Ann Smith. So I want to make sure that everything on here is really me. Okay. Then you're going to have public records. If you have any bankruptcies, any lawsuits pending, any back child support, any unpaid taxes, tax liens, any of those kinds of things, all collections. If you walked away from a bill at AT&T, it's going to show up on your credit report. Anything in public records will bring you down a bare minimum of 100 points. So if you have an 840 and you have a public record, you're going to be lucky to be at a 750. Any type of public record is very damaging to your credit report. So make sure you look at it. And if there is a public record, you take care of it. So I have another story for you because I love stories. So I had this 72-year-old couple, both of them 72. They'd been married, I don't know, 40 some years, and they were retiring and they wanted to buy a place in Florida. But they wanted to buy it, move, then sell their house up here and be done with it. And then they would take the sell of their home and be able to do that. But they didn't have enough money saved to do that. So we were going to do a home equity for them because they pretty much own their house outright. So we were going to open a home equity so they could have $300,000 to go buy a place in Florida. And then they were going to sell their house up here and take the $300 they made and pay that equity off and own their home in Florida and be done with their home in Indiana. Great plan. Lots of people do that. So we go to do it again. They say they have great credit. We pull it. It's like barely 700. So I'm like, oh, it's going to be a little more percent in loan than I thought because your credit's only 700. And they were like, what? So I'm like, well, here's your report. Let's look at it. So we pull it out. They had a collection for $20 for AT&T that was killing their credit, and they had it on there for 5 years. And I'm like, did you know you owed AT&T money? And they're like, no, we left AT&T and we went to Verizon, but we thought our bill was paid in full. Well, it wasn't. They still owed $20. They claim they never got a bill. No one ever paid them, and it went to collections. So a lot of people, again, they don't understand how collections work. So what happens is AT&T, after a certain amount of time, they can't get the money back. So they take all the people who owe them money and they sell those collections to a collection company. So they might have $1 million owed to them in collections, and they'll sell it to the collection company for $200,000. So now they're done with it. The collection company takes all that debt and goes after it. And so if they can recover more than $200,000, now they're making money. If they can recover half of it, $50,000, they've just made $300,000. Okay, so I'm working for a collection company and they give me 100 people to call, and I'm going to get paid on who I get money from. So am I going to call somebody who owes $20 and spend my time, or am I going to call somebody who owes $4,000? Okay, it is in my best interest to call the 4,000. I'm going to make more money, right? So I'm going after the bigger dogs. So not surprisingly, no one's ever called them, ever sent them a letter. They had no idea it was on there. So I showed them how to dispute that, pay it off. We took care of it, called the collection company, paid it off, disputed it, asked for it to come off their credit. They rose right up, and we were able to get them the best loan that we had. The other part of your credit report is your accounts, your trade lines. So your Target card, your Amex, your Discover card, your Visa, MasterCard, your car loan, your student loans, your mortgage. Those are all your credit accounts. Okay, so those are called trade lines. They're going to tell you how much debt you owe on them, how much debt you opened when you started, what you owe now, and how you've done on your payments for the last 2 years. So 24 months of payment history. If you've been a day late, you're going to have a 2. It's going to hurt your credit. It's going to show everything that's been paid. It shows all open and closed accounts. So my credit report's like 10 pages long because I used to get cards for every store in the world because they would say, hey, it's 10% off. Do you want this card for 10% off? And I'd be like, yeah. And I'd buy it, you know, and I'd get this stupid card. And then a month later, my bill would come because I didn't have a handy phone like you guys do where you can see your debt every minute. I didn't know till my payment came in the mail, and I said, oh my gosh, I owe more than I can afford. And but that didn't stop me, and I kept doing it. You know, eventually I did stop, and I learned, and I paid them all off and cut them up and stopped using them, and they closed. So they still show up, but they don't hurt my credit anymore. So really, any closed accounts are on there, but they don't have any bearing, but they're still on your report. The last one are those inquiries. Who has pulled your credit and looked at your credit over the last 2 years? There's a list of those at the bottom of your credit. So my challenge to you is to go to annualcreditreport.com and pull your credit. Don't worry about the score, but actually look at the credit report. What's reporting? Are you getting ones? How much room do you have on your lines? Are there any public records that you didn't know about? And is any of your personal information incorrect? Okay, so if you have horrible credit, there are credit repair organizations, but there's a million scams out there, ones that claim to do what they can't do. So the government passed a Credit Repair Organization Act. And just so you know, there are things that they can and cannot do. And I'm going to give you 2 websites. If you do need credit repair, or you know somebody who's in desperate need of credit repair, they should check the credit repair company on both of these websites. And if they show up, they're legit and they're good. They would not get accredited by these 2 if they were not good. So if you're gonna work with them, please check them out. So always monitor your credit report and your scores, pay your bills on time and regularly, get some counseling at your local bank or with a organization you know is good, and consider some different financial products to try and get you out of there. So we talked a little bit about scams. I'm going to go a little faster through this. Through credit repair scams. A big scam is if they ask you for signatures on blank paperwork. If they tell you they can get to take care of all the negative information, we'll take care of all the negative information. Not true. They can't remove those things. If they ask you to pay an upfront fee to repair your credit, walk away. They can't charge you till they've done something for you. That's the law. That's the credit report law that I just showed you. They are not allowed to charge you until they've actually done something to fix your credit. Then they can come back to you and say, here's what we've done, here's how it fixed your credit, and here's what we charge. So that would be something to look at. Here's the 2 places you should go to make sure you're working with a legit company that knows what they're doing and is in this for the right reasons and is accredited. So you want to make sure you go to the National Foundation for Credit Counseling or the Financial Coaching Association of America. I always look in both. So if I have the name of somebody, if somebody calls me and says, hey, I'm going to go to this credit counselor and here's their name, are they legit, Nancy? I'm like, hey, let's go in here and take a look. And we'll go in and look at both places. And when they show up in there, you know you're working with somebody you can trust. So how do you improve your credit? Stay less than 30% on all your credit. So except a mortgage, you can't do that, but and a car loan, but everything else, any credit cards, any store cards, any lines of credit, try and stay under 30%. So if you have $1,000 card, 300 and under, do not max out any cards, pay your bills on time, pay off credit cards each month in full if you can. Pay your loans on time, pay your student loans on time. Ignorance is not forgiven. So you can't say, oh, I didn't know my first payment was due. Nobody called me. Well, nobody has to call you. That's your job. You took out the loan, you signed the paperwork. The paperwork clearly says that you have to start making payments 6 months after you graduate. You have 6 months to figure it out. If you don't, and you don't make that first payment, you're going to get a 2 or a 3 or a 4 instead of a 1, and you're going to destroy your credit before you even get started. So you can't use ignorance as an excuse. Know the fine print. Do not apply for multiple loans and credit cards at the same time. Too many hits to your credit is very painful. Make a financial plan or debt management plan to reduce debt. Get help if you need to do that. That's what we do. That's what banks do. It's what credit unions do. Come on in and ask for help. Get somebody who knows, you know, you're not going to fight cancer by yourself. You're going to go in and get a doctor to help you. You know, we go in and get our teeth checked twice a year to make sure they're okay. We go for a physical once a year. You should go for a financial checkup once a year in your life. You should be meeting with somebody who's handling your money at least bare minimum once a year. It is just as important as your health, because financial stress can cause health problems. So make sure you're doing that. Review your credit report at least once a year to look for fraud. I gave you 3 examples of things that happen on credit reports that you would never know had you not gone in and pulled it and looked at it. So make sure you do that. Okay, so we are going to talk just for a few minutes here about tips when you start a new job. Okay.
One quick question before we move forward.
Sure.
That we got on the credit. The question is, does your eligibility for annual credit reset January 1st of every year? And do you have to wait a year after you request again?
Yes. So it's in a calendar year. You can pull each one of those bureaus one time for free in a calendar year. You can pay to pull a second time. I think it's $10 if you're nervous, or but if you've had fraud on any type of an account, like a bank account or a card, you can go into annual credit report, tell them you have fraud, and they will give you a free credit report due to that fraud. Okay, so there are ways to get a second free one, but it is one time annually. They are required by law to give you a free access to that entire report. And so I pull mine 3 times a year, but I pull TransUnion in January. You know, I pull one like every 4 months, basically, so that I'm looking at my credit 3 times a year. And my credit's locked too. Just an FYI, on that same website, you can freeze your credit. That means nobody could open a credit card, a checking account, a mortgage, a car loan, nothing. It does not affect your current loans or your current things that you have, but nothing new can be opened when your credit is locked. Now, people sometimes forget it's locked. So they'll come into the bank and say, hey, I want to open a savings account and I want to get a different credit card. I like your card better and I want to switch. And we'll go to do it and the system stops me cold because their credit's frozen. And I might even know them personally, but I can't override the system. When your credit is frozen, your credit is frozen. So you have to go back in to annual credit report, unlock it, then come back to the bank and open the account and do that. So you have to be able to unlock it to do anything else. But it's a very good practice to lock your credit when you're not using it. Very difficult for older people. Sometimes I have a lot of people frustrated, and it's not easy to unlock it if you don't have the passwords. And this age group, you guys are super good at keeping passwords, understanding passwords. Like, it's just a part of your life. You've grown up with it. But for old folks like me, you know, I can't remember what password I put on where and what, and I'm constantly having trouble. So people that are even older than me have even more problems. So just know when you lock your credit, it's important to be able to unlock it too. Okay, what else?
That's it. It's good.
Okay. All right, well, let's move on to this last part here. So tips when starting a new job. So the number one best advice I can give you is, from day one, enroll in your 401k, and you have to contribute your company's match bare minimum. Okay, from the first day you take your job. Even if you're going to live in New York City, Chicago, and you think, I can't afford to do that, I'm going to need every penny I need to live on. I'm telling you, you will figure out how to live on your take-home pay. We all do. But if you think, I'm going to change next year and add to my 401k, I guarantee you won't. Okay, so if your company says, I'm going to match 3%, then you better be contributing 3% and make sure you get that free money that they're giving you. If they match 6%, then you should be putting in at least 6%. Don't leave a penny of free money on the table. Okay, so match. Now you can go all the way up to 15%. So if they match 6% and you put in 9%, that's great. If you can put in more, put in more. So I want you to look at this graph because this really, really hits home. So the blue line that goes the highest is Chris. Chris invested $5,000 annually between the ages of 25 and 65. So for 40 years, he put $5,000 into his 401k. Okay. So in total, his money was $200,000. Now, 65, at age 65, he's ready to retire. That would be worth over $1 million today. Okay. That's what those investments do when you start young. He's got 200,000, 40 years later, he has $1 million to retire on. So let's take a look at the green line. The green line is Bill. Bill invested 5,000 every single year, but he didn't start till he was 35 because like I told you, he thought he needed that money. He didn't get started very young, okay? All these reasons why. He started at 35, so he only had 30 years. So he's got 150,000 of his own money in here. His value is 505,000. Still a nice pocket of change. 35 is not too late to start, but he's got $500,000 to stretch over the next 30 years because a lot of people live to be 95. Okay, so if he retires at 65, he's got 30 more years of going here. So he's got half because he started 10 years later. Okay, so think about that. The difference is only $50,000. So Chris put 50,000 more in, but because he started at age 25, he has doubled what Bill has. Susan started the same age as Chris. She started at 25. But for some reason at age 35, she stopped. Maybe she became a stay-at-home mom, had a baby, whatever. Something happened where Susan was no longer contributing. So she contributed only for 10 years, but she started young at 25. So she's got 50 grand in of her own money. Her portfolio would be worth 562,000. So she even has more than Bill, and he's got 100,000 more of his own money in there than she has. So the key here is start the day you take your first job, put in bare minimum the match. Now, I didn't put this on a slide because I forgot about it, but let's talk a little bit about what do you invest in. When you get this 401k, they say, where do you want it to go? You have to pick the funds. You pick where this money goes and you don't have any idea what you're picking. So another rule of thumb in today's world for your age, the age group you guys are, you want to diversify. So you want to have half of your percentage going into a Roth and the other half going into traditional. So when a company does a match, they almost always say the match has to be traditional, which means no taxes get paid. These are pre-tax dollars that go into a traditional. And then you are going to pay the taxes when you're 65 and you take the money out, or when you're 75 or when you're 85. So in a traditional IRA or a traditional 401k, when you take the money out at retirement is when you pay taxes for the first time. So the money that's going in is pre-tax dollars. Okay. A Roth 401k or IRA, they're going to take tax dollars out when you put the money in. And then when you take the money out at age 85 or 75 or 65, you don't have to pay any taxes on it because you paid taxes prior to. Okay. So you really want to have a diverse portfolio. So let's say the company matches 3%. A very smart move is to say, your match, I want traditional. My 3%, I want Roth. Okay. Now you have diversified. Okay. Then you have to go in and pick what funds you want. Okay. So if you have a friend that's in, finance and, you want to talk to them, do that. If your parents have a finance person, you can show them the funds that you have as an option and say, what would you recommend, and get their advice. But rule of thumb is when you are 40 and under, you can be extremely risky, because the higher risk, the greater the return. And you have time to recover from a bad dip in the market. As you age, so like for me at 58, I was nervous this year. Election years are always volatile. The market's all over the place. 2008, the whole country took a huge hit. It took my husband and I about 4 to 5 years to recover from 08, to get all the money back that we lost that year. I was fearful that that was going to happen this year with COVID, and so far it hasn't. But I did want to move things a little bit safer, because I'm older and I don't have 4 or 5 years to recover anymore. So as you age, you should move your funds to safer and less risky funds, which means your return might not be quite as great. So when you're first getting into this as a young person, remember, this is money you're not going to touch for 40 years. 40 years. You should never take money out of your 401k. It has got to be the last resort, the last place you're going to take money out of. So you're saving this for 40 years. So if there's a dip in the road, you've got time to come back from it. And throughout my 40 years, there's been a lot of dips up and down. But let me tell you, the market has gone up, 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 up. Even though it's gone down in between, it still has gone up. And this, what I have on here for you, is an example of somebody that started to save 40 years ago and where they would be today. So remember, you are going to learn to live on what you make. So make these decisions early on and stick with them. If you move jobs, by the way, I highly recommend you roll over your money from one company to the next, or roll it into a personal IRA, because people forget where their money is over time. I mean, when they move from place to place to place, it's crazy when you look in the paper at all these people who have unfound money because they've left $4,000 on the table, and 40 years later it's worth 140 grand or more than that, so make sure that if you move jobs, you move those portfolios with you, and don't forget that they were there. One last thing on this slide, the difference between a 401k and an IRA. So a 401k is offered by an employer, and it is kind of a benefit or a perk, and everything is done through that. An IRA is something you open personally outside of work, and there's limits to how much you can put in to be tax-free per year, and there's limits to how much you can make. Okay, so if your income is too high, then you can still put money in an IRA, you just can't take the tax benefit for it. You can put, I think it's like $6,500 a year into your IRA, and get a tax break if you're under a certain threshold. And I'm not a tax consultant, so I think if you make under 150,000 or something like that, you can put 6,500 and then have it lower your tax basis. So you have 2 different ways to save for retirement. Okay, I think we only have a couple slides left. Next one is healthcare. So I hear a lot of young people when they get their first job, they're like, oh my gosh, I go and they do my package and they're like, you can have a PPO, you can have a high deductible, you can have this, you can have that. And I am like, I don't know what healthcare to take. Okay, so that's another huge decision. What healthcare do you take? So I'm going to give you the basic 2 that almost every company offers. So if you are a relatively healthy person and your company offers a high deductible healthcare plan with a HSA, that is your best bet. If you have any kind of pre-existing condition, you take a drug that's expensive, let's say you're diabetic or epileptic, and my husband's a diabetic, so I know what the cost of insulin and all those kinds of things are. So I'll give you an example. My husband is on his own plan with his company, and he's on a PPO because his expenses are just too high. We would have to meet our deductible every single year in the high deductible plan for him. And it's way better for us to pay the higher premium and be in a PPO for him. Me, I'm very, very healthy. I don't take any medicines. I do my well checkup every year. Maybe I have strep throat once a year, hardly anything. So my healthcare costs are very minimal. I am in my own insurance with my company, and I do a high deductible plan, and I fund my HSA fully every year. So that means that if I did get really sick, I would have probably close to $5,000 out of pocket before my health insurance would cover. That's what a high deductible means. It's like $2,500 out of pocket before insurance pays even a penny. Then it only pays 80% until $5,000 out of pocket. Then it pays 100%. But for me, that's fine because I have $40,000 in my HSA because I've been saving in my HSA for 14 years now. So what an HSA is, you can put money in your HSA, and some companies put money in your HSA tax-free, kind of like a 401k. So for every $1,000 I put tax-free into my HSA, 250 of that is money I would never have seen had I been paid that through my paycheck, because we pay about 25% in payroll taxes to various Social Security, federal tax, state tax, local tax. So when your job pays you $1,000, you net or you see about 750 in your paycheck. About 250 of every $1,000 goes to taxes. When you put that same 1,000 in your HSA, you get the whole 1,000, because the government says we want to help you with this high deductible plan. So we're going to allow you to put that money in tax-free. So same thing when you put that money into your 401k. In a traditional, you don't pay those taxes on it. But on a 401k, you pay the taxes when you take them out. On an HSA, you never pay taxes on it. When you take the money out and you use it on healthcare or dentist or chiropractor or eye doctor or hearing doctor, glasses, LASIK, hearing aids, crutches, any prescription, any doctor visit, hospital visit, any of those things, you use that money on those things, it's tax-free. You never pay taxes on it. And if you watch your grandparents and your parents' age, you'll see how much money they spend on healthcare. Trust me, even though I have 40,000 in my HSA, I'm going to need it. I mean, one powered wheelchair is $10,000. Healthcare is a real thing, and there's a lot of need for it. So I don't think it's money not saved. But of that 40,000 that's in there, remember 10,000 of that is money I would never have seen had I taken that in a paycheck, because I would have paid those in taxes, that 25%. So you're limited to how much you can put in an HSA every year. So like this year, if you're single, you can only put 3,600 in. If you carry family on your insurance, you can put 7,200. If you're over 55 like me, you play catch up and you can put 4,600 in for a single plan and 8,200 for a family plan. That's your limit that you can put in, but you can grow it from year to year to year to year. And there's no limit to how large it grows over time. So when you get those packages and you're trying to make a decision, PPOs cost a lot more out of your paycheck. So they're going to charge you $100 a paycheck. High deductible is only going to be $50 a paycheck. But if you get sick, your out of pocket for a PPO sometimes is only $1,000. Your out of pocket for a HSA is going to be $5,000. So while it's cheaper to have the high deductible, if you're healthy, that's great. But if you have a car accident or something happens, you better have been saving that money in your health savings so that you have that cushion if something should happen that's catastrophic. So I hope that helps you understand the difference between those two. Let's see. So next thing is budgeting. So make sure that you do actually budget. The wealthiest people in the world know where their money's going. So sometimes somebody will say to me, "Oh my gosh, I got $1,000 back in taxes this year." And I'm like, "Oh, that's awesome. What did you do with it to improve your financial life?" They look at me and they're like, "I don't know. It just went, it's gone." Like, I don't even know where it went, you know? So if you don't know where your money is going, you're never going to save and you're never going to get wealthier. Remember that you should have a 6-month net income savings account. So if you make $1,500 a month, let's see, 2 months is 3,000, 4 months is 6, 6 months is 9,000. You should have $9,000 in a savings account. And so whatever you're living on month to month, you should have 6 months of that saved. 3 minimum, 6 is the healthiest. And you're not going to be making a lot of money on that money because savings accounts don't pay a lot in percent, but you're not trying to make money on that money. That's liquid money that you can use in an emergency if somebody loses a job or somebody gets sick and has to go on short-term disability, you know, your car breaks down, because the last thing you want to do is have to use a credit card to pay for emergencies. Credit cards are 18 to 26%. It's highway robbery. So make sure you build in savings from day one. So the 50-30-20 budget rule, when you first go, 50% is your needs. That's going to be your food and your housing, 20% into savings, and that leaves you 30% of wants. So if your needs are more than 50%, so you decide I want to live in a nicer apartment, so it's going to be 70%, then you have now just cut your wants to 10%. So that means you don't get to go out as often, you don't take vacations as much, you don't buy new clothes, you don't buy new things. So if you want to have more wants, keep your needs less, but keep that 20% savings until you've built that 6-month savings, and then you can give yourself a little more on the wants and needs side of that. One last thing, BMO Harris Bank has a Smart Progress educational tool that I am going to give to you guys. The second line here, this one right here, that says Smart Progress Indy, if you type that in, and I can send the live link to Garth, then you'll see these pillars. When you click on one of these pillars, you're going to see a list of classes. They are 3 to 6 minutes in length. These are all the classes that are embedded in here. So there's one on car loans right here, buying a home, considering home ownership. Like, you need to think about some things before you even actually do it. How to budget, taxes, any changes to the tax laws this year, 401k, an IRA, annuities. All of these classes are free. They're 3 to 6 minutes long. How do you build wealth? How do you do things? You get smarter, you read, you learn. So feel free to take advantage of any one of these classes, learn more about things. Again, they're only 3 to 6 minutes long, but they have a lot of very valuable information. If you ever want to bank with BMO, we are the largest bank in Chicago. So if your job when you graduate takes you to Chicago, you're going to see a BMO on every corner. We are huge in Milwaukee and Minneapolis and Indianapolis. We do have promotions. You can open accounts online. This is how you open it online. I do have a promotional bonus just for you. It's $100. And this is the bonus promo, and here's where you put it. We don't have any brick and mortar in Michigan, so not sure if anybody's interested, but if you are, it's on there. And if you're not, that's fine. If you love your bank, then I'm happy for you.